In this video, we're going to be discussing long-term corporate debt. Of course, such debt is used by corporate issuers predominantly to finance, to fund long-term needs, such as capital investments, so longer investments which will bring benefits over a longer period of time. Now, a lot of this video is going to be about differences between the borrowing of investment grade issuers or borrowers as opposed to high yield. We already discussed this distinction in a previous video. It's all about the relative quality of the borrowers. Nevertheless, before we move on to those differences, we definitely need to talk about some of the similarities. So one of the similarities that we find is that at least under normal market conditions, and this is an important disclaimer, under what we consider to be normal market conditions, and normal market conditions means we have a rising upward yield curve, which at least recently has not always been the case. We've had plenty of years with inverted yield curves. What does that mean? Under normal conditions, borrowing for longer periods, for longer terms, should normally be or is more expensive than short-term borrowing, expensive than short-term borrowing, or issuance of short-term debt or taking of short-term loans should be cheaper than taking longer-term loans. Now, this generates a very interesting trade-off, which I want you to appreciate. Well, first of all, the way we're going to discuss long-term corporate debt and the costs associated with it is we're going to have a chart where on the horizontal axis we're going to have the maturity or the term for which the loan or the borrowing is taken. And on the vertical axis, we're going to have the yield earned by the provider of that funding, which is also the cost from the point of view of the funding taker, the borrower. This yield is often referred to as the YTM, or the yield to maturity. But you don't have to concern yourself with that too much right now. We'll use YTM, yield to maturity, and yield interchangeably, and in a couple of videos time you'll see how yield to maturity is actually computed. So over here I'm going to draw first of all a curve, and it's normal in the sense that it's rising. The yield expected by providers of funding becomes higher as we increase the term, the maturity date, as we extend the maturity date. Now, very importantly, the one I've drawn so far, I'm going to consider this, or I'm going to make this my government benchmark yield curve. Government benchmark yield curve. So this is a collection of points on the graph, on the chart, denoting the cost at which the government can borrow for different periods of time. And it is indeed an important benchmark in the economy if you've got such a curve, because corporations, given the higher risk that they pose as issuers, typically borrow at somewhat higher rates. So here we're going to have a corporate yield curve. Obviously, this is not for all the corporations. It's for a specific company, for a specific issuer. They can issue bonds and borrow money for different periods of time, but they do it at higher cost, at higher rates than what a government would need to offer to borrow money for the same period. The difference here that you see right, at different points. This is known as the credit spread, simply. And it is very much correlated to the quality of the issuer. The better the issuer is from a credit quality perspective, the lower that credit spread is going to be. But we typically deem the government to be the highest quality issuer in the economy, obviously under normal conditions once again. So there's always going to be that element of credit spread for corporate issuers. And please note that this credit spread has a tendency not to be fixed along the maturity spectrum, but it actually becomes wider or bigger for longer maturities. And that's an important consideration. The credit spread is higher for longer term issues. Okay, now let's imagine some points over here. Let's say this is a period of 5 years. Let's say over here we've got 8 years and 3 years as well. So I've got 3 different points. Okay. If you are a bond issuer, a corporation, you will see, obviously, that it's cheaper to borrow for a shorter term rather than for a longer term. So imagine I'm a corporation and I need to fund, so let's say a corporation, a company basically, needs to fund a 5-year investment project. The natural thing would be to borrow for 5 years under a bond issued for a 5-year period. However, that is relatively, let's say, expensive for a corporation because the yield you need to offer to buyers of the bond, the investors, is quite high. Obviously, it would be even higher if the time to maturity were 8 years. But the temptation is perhaps to, despite needing the money for 5 years, use a 3-year bond. So basically they issue, so uses a 3-year bond, so issues that bond because of the lower cost associated with it. And once the 3 years are up, you're going to have to make a repayment, a redemption on the bond. And the only way to do it will probably be to borrow again, so refinance the existing obligation by issuing more bonds for the remaining 2 years. And this exposes us to refinancing or rollover risk. So this exposes the issuer to rollover or refinancing risk. Nevertheless, despite this risk, it's a tempting thing to reduce your cost of borrowing and then hope that you'll be able to refinance once again at a pretty attractive rate. Now, something similar may be happening from the perspective of the investor. You may have an investor with a 5-year investment horizon. So somebody who knows they can commit the money for 5 years, but then they'll have to cash out, liquidate the investment because of some need to spend on something. So you can invest in 5-year bonds. That would be the natural thing. But instead of going for this, you may, as an investor, go for the 8-year option because it provides a higher rate of return, a higher yield naturally. So even though they've got a 5-year horizon, they invest, so the investor invests in 8-year corporate bonds. I mean, the same argument could essentially be made for a government, for government bonds, in 8-year government bonds, because of the higher yield. But that yield is really true only if you hold the instrument until its maturity date. You'll earn that amount of money. That there's a reason why it is called the yield to maturity. Here, after 5 years, the investor faces price risk. So this strategy exposes the investor to price risk, having to, up front you're going to have to sell this bond prematurely before its maturity date, and you don't know what price you're going to get after 5 years. You only know what the issuer has promised you after 8 years are over, and you would generate this yield to maturity, this high one, if you kept the bond for 8 years. There's also an argument about how you would reinvest the coupons, but that's kind of besides the point right now. So there's always trade-offs, right, that exist for issuers and investors. And these trade-offs between higher yield but needing or lower yield but wanting the money for a certain amount of period, or wanting to invest funds for a certain period, these trade-offs exist, irrespective of whether we're talking about high-quality issuers, highly rated issuers, or perhaps lower quality or high-yield issuers. So, I just wanted to focus on those similarities first. Okay, so the main focus of this section within the relevant learning module is on the differences between how investment grade issuers, who we abbreviate as IG, and so-called high yield issuers, HY, do bond issues, so their bond issuance. Investment grade are the good quality borrowers or issuers. High yield are the lower quality issuers. So these are terms we introduced earlier anyway in a different video. Let's start with the investment grade issuers. Mind you, remember, we're not talking about government issues. We're talking about corporate issues. So these guys are going to definitely enjoy a lower credit spread as opposed to a higher credit spread, which is going to be true for high yield, or as your book puts it, in their case, because the spread is going to be relatively small, the spread above the government benchmark yield, it will, that green little interval here, which is supposed to denote a low spread or a narrow spread, it's going to make up a smaller portion of the overall yield. So if the overall cost of issuing bond or the yield for investors is this much, the spread aspect of it over the benchmark curve is going to form a relatively low or small proportion of the overall yield. Let me write this down. The credit spread accounts or is a smaller proportion of the overall yield. Obviously, a bigger, larger proportion is attributable to the government benchmark yield. Government benchmark yield, which was the basis for computing any yields. When that goes up, everything else goes up as well. Now, from a different perspective, okay, so we have lower credit spread, brilliant. These types of issuers and their issues are going to be definitely less associated with restrictions or negative covenants that will restrict their actions. Less restrictions put in place by lenders, less covenants of a prohibitive nature imposed on the issuer. Now that's quite obvious. But also, I guess, because of the higher quality of these issuers, less monitoring efforts, less monitoring on the part of the lenders is needed. Because of their, once again, good quality, they will have a lot more flexibility to issue even very long-term instruments, flexibility to issue even very long-term bonds, very long-term securities, for example, 30-year ones, just like governments have. And another point is, and this is, I mean, this is very important from the way for understanding how the market works. Good quality or investment grade issuers typically issue pretty much standardized debt. So standardized bonds, corporate bonds, and they will have many issues outstanding at any single point in time. Have many issues outstanding at once, right? Those issues will have similar terms, similar parameters with similar terms, so they will typically be offering a fixed coupon of a certain level, but they will have different maturities with similar terms, but different maturities. The point is, you want to stagger in the maturities. You don't want to have all your debt. So this is called staggering of the maturities. Spreading them over time, staggering maturities. Because you don't want all of your bonds to mature, irrespective of when they were issued, to mature on a single or one date, because that greatly increases the risk of not being to refinance or roll over if something negative happens on that given day. So this reduces rollover risk. And maybe I should say, maybe this is not obvious to some of you. When companies start issuing debt, when they start borrowing money, they typically don't repay that money, that borrowing, and kind of later on live debt-free. No, once you start borrowing money, it's a very conscious decision to bring debt onto the equity and liability side of the balance sheet, and that debt stays as a permanent fixture. It's a permanent element of your capital structure. So you're not going to necessarily pay the debt off as such for good. You're simply going to replace it with fresh debt. So you'll have to roll over and refinance by issuing another set of bonds, and you don't want that to happen on a single one day. Just in case that day is problematic, maybe the conditions in the market are harsh, it's better to stagger stuff out over a range of dates rather than do it all on a single date. And this also gives the company, plus company, reduces rollover risk, plus company retains the ability to issue additional debt, more debt, if conditions in the market, if conditions are favorable for it, for the company, right? Instead of doing everything all at once, issuing everything and having everything mature on the same date. No, we typically don't want that. And another feature of this is that the debt is quite standardized, and very importantly, it is going to be very much unsecured. So the lenders do not necessarily require collateral to be in place because they know the situation is good. Now, you also have to understand what analysts focus on here when they look at such debt. The analysts pretty much focus not on the likelihood of the company going into default, because that is a very remote possibility. Instead, analysts focus on the likelihood of a rating change. Ratings are the way in which issuers of debt get assessed by external rating agencies. So likelihood of rating changes, somebody dropping from, double A to single A or getting upgraded, that's what gets analysts going. They don't really think about the probability of anybody defaulting as such. So what they do is they analyze financial statements, they look at ratios, they look at, obviously they look at ratings and rating changes and what agencies write about the issuers in their reports, etc., etc. Okay, let us now focus on the other type of issuer. That's going to be the high yield issuer. Obviously, these are issuers with, lower credit quality and therefore higher risk of default. So, quite naturally, their borrowing will come with a much higher credit spread. Obviously, we're talking about the spread over the government benchmark yield over here. So they will issue bonds with a much higher spread, and that spread will naturally become a bigger portion of the overall yield or the overall cost. So larger portion or proportion of the overall yield. Okay. Now, obviously, the likelihood of a default, the higher probability of default, that's pretty much to do with the fact that these companies have less stable operating cash flows, uncertain or less stable operating cash flows. And because the likelihood of default, the probability of default is quite considerable, you're going to have these bonds behaving more like equity. Bonds are more definitely equity-like as a result. You cannot really rely purely on the assumption that they're going to generate a fixed level of income for a certain number of years and then get redeemed. Now, this also feeds into how analysts look at such companies. Analysts focus on things like the probability of default here. How likely is it that the company will stop paying on its debt, so the PED? But also, if default happens, what's going to be the loss given default, so the LGD, loss given default, and that is hugely impacted by the collateral arrangements in place. What is the hierarchy of getting repaid in the case of default? Which lenders, which creditors get money first? Who gets money later? Who is secured on what? So those kinds of considerations are very important. Also thinking about secondary repayment sources. Secondary meaning if the company is not generating enough operating cash flows, then how are we going to recover the money potentially from the sale of what assets, etc. What is available to the company to meet the terms of its bond issue, so as to avoid a default. Okay, another point here is that because of the lower quality nature of these issuers, they're going to face more restrictions. So more restrictions on the issuers. So much stricter covenants. This is obviously to protect the interest of lenders. Making sure that the companies behave properly, that they don't do transactions that would be detrimental to the interest of the bondholders or the lenders, like paying the owners, shareholders, huge dividends, for example. And an important restriction is going to concern, for example, additional debt, restrictions on the ability of the company to take on additional debt, because the more debt you've got, the more lenders queue up in the case of default to see something from the assets. So restrictions on additional debt, and you may remember from a much earlier video in the fixed income section that often if there is to be additional debt, the existing debt holders want it to be subordinated to their debt. They never want that debt to rank equally or, God forbid, higher than their existing debt. Right, what else? Definitely, you know, as a kind of reflection of what we did here in the mirror image. Here we said less monitoring efforts are needed for the high quality or investment grade issuers. Well, here there's going to be definitely more need to monitor, more monitoring efforts, more monitoring of issuers' condition, their financial condition. Yeah, as we said here, restrictions, especially restrictions, so maybe, wait, this arrow should go from here, restrictions on additional debt, which feeds into another point, high yield issuers, so lower quality issuers. The reason why they're called high yield, by the way, if you've forgotten, is because in order to attract investors, because of the higher risk, they have to offer bonds with a much higher credit spread, offering a bigger yield, a bigger rate of return to the investor, which is obviously compensation for the higher risk which they take. So high yield issuers definitely will have less flexibility to issue additional debt, to expand their overall amount of debt. Obviously, potentially it's going to be okay if it's going to be subordinated to existing, unless it is that new debt is subordinated, so ranks lower than the existing debt in the order in which claims are potentially, in the case of a liquidation, claims are satisfied. This didn't come out right, so let me rewrite this word, subordinated, to existing debt. Okay, good. What is more? Typically, the maturities are shorter, of course. Maximum something like 10 years, whereas the high quality borrowers can issue unsecured debt for much longer periods. We even said, something like 30 years, and they're going to face a lot more fluctuations, so higher fluctuations in the availability of funding to them, availability of debt funding that is made available to them. As conditions in the market fluctuate, credit spreads will fluctuate, making this form of borrowing prohibitively expensive at times even. And anyway, in times of market stress, lenders may simply be reluctant to give their money to anybody whose rating is not good enough to classify it as investment grade, thinking this to be a risk that is simply too big. So as economic conditions in the market change, these guys will not necessarily have the same level of access to debt funding, whereas investment grade borrowers typically can issue fresh debt all the time, even in pretty poor economic conditions. Right, okay. A point that you need to appreciate is that in order to have some level of flexibility, right, in their sort of borrowing structure, even though they are high yield and lower risk, they still want to have some flexibility. However, that flexibility comes in the form of borrowing or issuing debt with prepayment options built in. In the case of bonds issued, you're going to find call options often being built into the issue. Let me remind you that a call option is an option to repay or redeem the bond, pay it off ahead of the official scheduled maturity date. So this is going to be, that prepayment option will be especially valuable if you are a high yield issuer, but you expect that your situation may improve. So you need to borrow the money now, but you give yourself the opportunity, you reserve the opportunity to pay the bond ahead of schedule. If your condition does indeed improve significantly enough, you may issue fresh debt at a lower rate or with a lower spread above the benchmark government yield, so hopefully cheaper, and obviously replace the existing debt which came from a time when you were a high yield or worse quality issuer with something cheaper. However, one consideration to keep at the back of your head is that typically calling a bond or making use of the call option requires you to pay a call price which is at a premium to the face value. So if you want to redeem the bond early, you actually have to pay more than 100% of face value. It's a bit like a penalty for repaying the debt ahead of time, of the official time. So you've got to consider whether the saving you will make on the lower interest from issuing the bond now, fresh bond now, is going to be big enough, that saving, to offset the penalty that you'll have to pay for calling the issue ahead of schedule. So what's going to be the net benefit? Okay, and just a few words about an important category called fallen angels. We kind of mentioned this in the past. Fallen angels are former investment grade issuers who have gotten into trouble and they've fallen into this high yield issuer territory. So basically their ratings have been cut due to trouble. So the interesting thing about them is these fallen angels now have probability of default or PDs, probabilities or probability of default, PD, just like any other high yield issuer. So they're just like anybody else who's down here in this club, but a lot of their debt was issued back at the time when they were still investment grade. So their debt definitely has investment grade features, which makes for an interesting combination because the debt doesn't really suit the situation of the issuer anymore because it's changed. So it's typically non-callable, which is callable debt is very, very characteristic for high yield issuers, but that former debt or issued formerly isn't going to be callable. It will typically be associated with few restrictions built in, few restrictions, or few covenants, or very mild covenants, and definitely longer maturities, which are quite characteristic for the way in which investment grade or higher quality issuers borrow. So obviously, these specific characteristics come from the fact that this debt was issued at a time when the issuer was still an investment grade issuer, which they no longer are. As a result of becoming a fallen angel, right, as a result of that drop, a large portion of your previous investors, the original investors, typically need to divest, because you have to bear in mind that many, especially regulated financial institutions like pension funds, mutual funds, etc., may either make it a matter of their own internal policy, or even it's kind of this comes from external regulation that they should not hold bonds or invest into bonds of issuers below a certain credit rating. So many of the original investors are forced to divest, basically get rid or sell the bonds out of their holdings, and this typically creates significant downward pressure on the price, significant price drops, simply coming from the fact that demand for high yield debt is much lower than demand we see for investment grade debt. So the number of buyers interested in holding the debt of high yield issuers is definitely smaller than well, maybe not the buyers, but the amount of money that is put into high yield issues, investments, is definitely smaller than what goes into investment grade issues, especially when you take into account government or sovereign debt, which also is typically investment grade. And because of that lower demand, there's going to be lower prices as well. However, there are specialist investors who focus on such issues, focusing, for example, on distressed debt of companies who have gotten into trouble, which they buy at attractive low prices, obviously in the hope of the situation of the issuer subsequently improving, although that's a strategy we discuss more in the alternative investment section of the curriculum, where distressed debt is one of the strategies.